Hi, this is Chris Conroy, EVP of National Accounts with Insurance Agency Marketing Services, or IAMS, and I'm pleased to be hosting today's fifth and final webinar program of our Elevate Your Sales EQ, which we know you'll find to be a highly engaging conversation with nationally recognized expert on client financial psychology, Dr. Jack Marrion. This program will provide you tangible takeaways that you can incorporate into your practice immediately. IAMS has a deep-rooted commitment through its 34 years in business to delivering on one simple promise to our customers: to help you win by providing the tools and advice so that you can thrive. We're committed to winning your trust through industry excellence and leadership. This Elevate Your Sales EQ series delivers on that promise, the promise that will help make you a better financial professional in your relationships with your clients. And that's why when we talk with some of our top advisors how we could up their sales game, especially with the challenges faced by COVID, we focused our attention on how you can better connect with your clients on an emotional level by increasing your emotional quotient. Because we know it's one thing to have the highest IQ in the room, but that doesn't close sales. Having a higher sales EQ matters more. The ability to connect with your clients through empathy, understanding your own emotions, and communicating in ways that make sense to them. That's why upping your emotional quotient is so important. We held our first 4 parts of this series over the last 4 months, and we had a record level of participants, many of whom are also registered for today's program. For today's final installment of the Elevating Your Sales EQ series, we will move to a conversation about life insurance buyers and how you can overcome some of the common irrational biases that they have. Before I introduce our featured presenter today, I'd like to take a minute to thank North American Company for Life and Health Insurance, whose generous sponsorship helped make this webinar series possible. We've been pleased to partner with North American Sales VP Tia Stanley to create this webinar series. Her broad experience and skills in the insurance industry at both a leading distribution firm and with top carriers has made her a well-recognized sales leader. I also want to share our appreciation for the industry research and leadership that North American has shown in a recent top producer survey called Project Apex, which helps identify key attributes and behaviors of top performing producers in the industry. He is also a past recipient of the NAFA Next Gen Award and chair of the NAFA Education Committee. Tia, welcome.
Thanks, Chris. Can you hear me loud and clear?
I can.
All right, perfect. Well, I do want to say I'm so appreciative of you, also the opportunity to sponsor this series. It's definitely bittersweet that this is the last one. Wanted to give a shout out to my life colleague, Andrew Herrera, as this is going to be, talking about life insurance, with this last installment rather than annuities. However, did want to mention a couple of things on our annuity side. So I wanted to highlight our best-selling FIA VersaChoice 10 and then mention our EPC loyalty program. So for those of you that have tuned into this series, now is the time where I tell you we've got a great accumulation play. We've got first to market liquidity that's ADL driven to the cash value of VersaChoice 10. And like I had mentioned before, this is our best-selling fixed indexed annuity. Here's where I'm going to enter in a little new information though. This isn't just North American's opinion. This isn't just us saying that it's our best-selling fixed indexed annuity. The industry has also spoken. If you have not seen Wink's Q3 sales report, make sure you take a look at that. It mentions that VersaChoice 10 was the #2 best-selling fixed indexed annuity of Q3. That is huge. And so I wanted to let you know, yes, on our end here at North American, it is our best-selling fixed indexed annuity, and the industry has spoken that it's just as popular outside of our 4 walls. So again, if you haven't seen Wink's Q3 report, make sure you take a look at that. Also, when it comes to our elite loyalty program, our EPC loyalty program, the program that you got to know and love in 2020, it's going to be identical going into the new year, 2021. So we've got 3 levels. We've got our executive, president, chairman level. Based on your issued FIA premium, for the calendar year. So those qualification levels are 1 million, 3 million, and 5 million in issued FIA business. So if you'd like to know how North American can put an additional $75,000 in your pocket, make sure you reach out to your IAMS family, and they'll make sure that they send all the information you need on our EPC loyalty program. So before I pass it over to Chris, I got to tell you, I was thinking about this being the last series, and I kind of chuckled to myself when I was thinking about its popularity. There's so many people that are tuning in for IAMS, but also for Dr. Jack Marrion. And there's a popular commercial with a popular company that you've seen on TV quite a bit. And the quote is, "We know a thing or two because we've seen a thing or two." So the reason why you're tuning in to Dr. Jack Marrion and the reason why you're working with IAMS, it's because of that quote. They've both been around for an extremely long, reliable time. They've seen a lot in the insurance industry, and they've been able to report those changes. They've been able to move with those changes and also forecast to a degree. And so, again, in closing, I just want to say this is an excellent opportunity for North American to sponsor this series. I have my fingers crossed that we've got opportunities like this in the future. And with that, Chris, I'll go ahead and turn it over to you.
Yeah, thank you, Tia. Hey, and thanks again, North American. Again, without their support, we wouldn't have been able to do this program, so we appreciate that. And if you need more information on the VersaChoice, which is a great selling product, has really stood out in the industry. And frankly, I think North America as a whole has had it come out for a very good third quarter. I think probably one of the fastest growing fixed annuity carriers in that period. So good work there, and reach out to your IAMS marker. We can help you with that. And also on the life side, I mean, you guys have outstanding products. Andrew's not on the call with us, but if you need information on some of the very competitive and innovative IUL products and also term products, certainly can help you there. Well, now I'm pleased to introduce our industry think tank expert, Dr. Jack Marrion, as our featured presenter today. Let me share a little background on Jack. Jack's been the author of several top industry academic books. Index annuities, a suitable approach, Gen X, Gen Y, fixed annuities, real world index annuity returns. He's worked with the Wharton Business School, Professor David Babel, a number of other life insurance publications as well. Research studies with the Advantage Compendium. He's been an expert witness with the NAIC, past president of a broker dealer, past officer of life carriers, and past officer of an investment banking firm. And he's led academic research in how insurance clients think and what their internal biases are, with a doctorate from Webster University on behavioral biases, where he's been a research fellow. Also, Jack has won the NAFA Bo Johnson Lifetime Achievement Spirit Award, recognizing his many years of contribution to the fixed insurance industry. Jack, welcome to the program.
Thanks, Chris.
Well, thanks, Jack. And today's program, as we've done in the others, is pretty straightforward. Jack's going to lead us through his presentation. I'll have a couple questions and comments along the way to make this interactive. So we'll also have some polling questions, and we ask you to try to answer those so we can make this interactive. So you can see how other advisors are thinking, and there's some great informational pieces out there. So be on the lookout for those polling questions throughout the program. We'll answer those and get back to you collectively along the way. If you should have any specific questions, that you can go ahead and ask those in a chat box. We'll get back to you right after the program. And first one of which, I just ask a quick polling question, and some of you might have seen this with our advertisement, but if you would like a copy of our IAMS Smart Wealth Accumulation Guide focused on IUL sales, go ahead and answer yes there. It's a great piece we worked on. And we're happy to get that out. If you did not get it or you didn't see it with connection with your registration, go ahead and answer yes. We'll be happy to get that free guide out to you, so you can have that. We'll have some more too in a little bit here from Dr. Marrion's white paper, but first thing we want to pose out there is just for people who are interested in that. Okay, I'll go ahead and close that poll. Okay. And well, with that, Jack, let's get into today's topic: irrational biases with life insurance customers. And we know many clients are struggling to make that decision to move ahead and buying life insurance and thinking about it. And I think a lot of them probably intrinsically appreciate the value that life insurance can bring and the solutions it can provide. I guess the first question is, right now we're in the midst of COVID, and we hope for a vaccine, and Don't know when exactly it'll be available or at what scope and so forth. But in times of COVID, which, I think clients probably think more about their own mortality and have those fears, have those biases changed some that we're going to talk about today?
It's really amplified them. The biases are bigger than ever because of what's going on.
Yeah, it's certainly been our experience talking to advisors. I think, kind of puts front and center their own mortality, things that some people don't want to think about. But I think that's a good way to frame this. And, throughout today's program here, Jack, I might pose a couple questions of why that's a great point. But, times of COVID is, how do we think about this? Do we need to make a bigger point about certain things? So I'm going to pass it back to you, Jack, and we'll get into today's program.
Well, we can start with a tail. Hold on a second. Can we flip through a couple more slides, please?
Yeah, I'll go forward here. I'm on that real size life insurance.
Okay, let me regroup. All right. Okay. Since we're using the original slides, let's go back to the first one, and we'll.
Sure. Yeah. The how decisions really happen. Sure.
Yeah. Okay. We like to think that people make decisions rationally, that they take in the information, process it, and then present it. But unfortunately, it goes through a fog of emotions and different biases that can alter the decision. And what this is all about is trying to remove those biases, and so that people can actually evaluate the facts. That's what this is. So next slide.
Yeah, Jack, and look at this slide, the real size life insurance, about half of customers own policies, but sounds like that maybe not all of them necessarily are being asked to buy.
Yeah, it's kind of amazing. Roughly half the market owns the insurance, but the ones that don't, you have some people that say they don't need it, and that may be true, but they also may not realize they have a need. You've got people that don't think they can afford it, and the last survey from LIMRA found that millennials thought that life insurance costs 5 times more than it really does. They thought the premiums were $1,000 a year instead of $200 a year. And that's addressing that 3. And then of the remaining half that don't buy, you've got another quarter that they've never had an insurance agent talk to them. So just asking them to buy can open up the market.
Let's take a look at that narrow framing slide, the example about Starbucks. I kind of like that. I like my Starbucks, but what are some key points on that slide?
It's how we view things, and framing is so important, how things are presented. Because the examples here are, you'd go to Starbucks and you'd pay $4 for a latte. You don't even think about it. But if you translate that into ounces, that's a $40 can of coffee, and you wouldn't do that at the grocery store. You'd pay $7 for the beer at the ballpark, but that's the equivalent of an $80 12-pack from Budweiser. And if you sold lottery tickets where the player's family was guaranteed to get $100,000 if they came up with $1,000, but they kept playing, you'd have people lined up. It's a sure thing. But the same person won't pay that $1,000 premium for his family to collect a death benefit of $100,000. And it's all because of the way it's framed.
So let's take a look at that slide, about framing in the context of $250 or $1,000. I kind of like this one. Felt like it was back at the casino.
It's a lot of study behind this. They asked a lot of people, this is 30 years worth of asking people this question. And they asked them a pair of questions. Would you rather have $250 in hand or a 1 in 4 shot of winning $1,000 with a 3 out of 4 shot to get nothing? And in combination, if you had a choice between losing $750 or having a 1 in 4 shot of losing nothing, but the reality is the other side is you'd lose 1,000. People put A and D. They're risk adverse when it comes to a sure thing, money in their pocket. They're risk seeking when it's a chance to avoid a loss. That's how 7 out of 8 people make decisions. And that just reiterates what I just said. So people like having a bird in the hand. People are trying to avoid risk, and they'll take a chance to do so.
A question on that, Jack. I mean, some of this is a little bit of a function of the amount involved. So, yeah, a good example here, I think these are relevant dollars for most of the clients that people are working with. You know, if you chopped off, you made that, you know, $2 and $10, does that change things? I mean, it kind of goes to, you know, elastic versus inelastic demand.
If the numbers get big enough or small enough, yeah, I can't change it. But for most people, because they have used different amounts, this holds pretty true. Risk adverse when you get a sure thing, risk seeking when there's a shot to avoid a loss. It's the reason that people sell a stock when it's up, because you can never go broke taking a profit, but they'll hold on to that doggy stock as it goes down and down because it might come back. So same type of rationale.
Let's take a look at that in the context then of like that $200 life insurance premium example.
Yeah, and this is how it's flipped. If you're talking about life insurance, here'd be a choice. There's a $200 premium, $10,000 death benefit. So what you're really saying is, okay, here's your choices. You can win 200 bucks, not by the policy, and there's a very slim chance that the people are that you're going to die and collect 10,000. Alternatively, excuse me, a very good chance you're not going to die. Alternatively, on C, you can pay the premium, and there's a chance that you might die and actually collect. It forces us, if you can flip again, sorry about that. It forces us to pick B and C, to go against what 7 out of 8 people would do. That we want to basically not take the sure thing and be risk seeking when it comes to paying the premium, and risk adverse when it comes to loss. So it's an entirely different mental state than we have for almost everything else in life. The way you can change the framing is by changing the loss. 200 bucks is a chunk of change, but would you rather give your family 10 grand or 50 cups of coffee when you drop dead? Okay. It's a little different change of what you're giving up. Will you give up a cup of coffee a week to give your family $10,000 if you die? That's why those commercials have been around forever with the for pennies a day are very effective, because that's really what it amounts to, is changing the frame. You can also talk and change the idea of the risk. One idea is to show the people that have died. Another is just to have them face reality. Okay, Einstein, you get hit by a bus tomorrow. How are you going to take care of your family? That type of thing. And in the COVID environment, it's do you know anybody that has died from COVID? And the answer is unfortunately becoming increasingly, yes, I know of someone. So that shows that death is a reality. And again, it changes the framing of the question.
Yeah, good point there, Jack. I'm going to actually launch a polling question about that right now. And so this is a good one. I think collectively, if you go ahead and answer that, we'll share the responses to everybody. But how your average clients you're working with, have they, you know, more, same, or less? So I'm curious to get their feedback about their interest in discussing life insurance. I suppose there's some clients that maybe just want to stick their head in the sand even more, but certainly a lot of the advisors we're talking to feel like they're getting clients asking more questions and probably getting more referrals than they had before, but doesn't necessarily mean more sales, as the industry statistics have shown. Some of that has to do with just the ability to get some of those cases across the finish line. But I'll go ahead and close that poll and share the results here. So yeah, indeed, I don't know, about 52% are showing that clients are more interested and, just a couple less. Does that surprise you at all, Jack, or is that kind of supportive with your
That's
thoughts with
not at
COVID?
all. It's because of the increased risk.
Mm-hmm. Mm-hmm.
The frame has changed.
Let's move on to that next slide then.
And the other is to avoid loss and totally get rid of it. The example here is if they've got money sitting someplace and you can get them 0.5% more interest in, say, an annuity, you can present this as, would you rather keep your 250 bucks, leave it at the CD, or would you rather have a chance of getting $10,000 for your family and making 300 bucks, or would you rather make $50 less with your alternative is making $50 more and a chance to win 10,000? So basically what this does is it makes the annuity life combination a win-win situation and the CD a lose-lose situation. The key on this is it must be done simultaneously, because if you separate it and say, okay, we move the CD to the annuity and generate the 500, and then we spend $200, you've created the same problem again. The insurance becomes a cost rather than a benefit. But as a combination, you can do this at the same time, sign the apps at the same time, set them all up. This becomes a win-win for you and a lose-lose for the competition. And it's just very strong. But just don't break it up. Make sure it's one consolidated turn.
Yeah, is that one, Jack, where given the numbers involved, is it probably a good idea to show the dollars? So like sometimes it becomes more meaningful when you're talking hundreds or thousands potentially as a solution.
But you show the solution and you can show your work, you make your work available, but the key point is showing the net. So you
Mm-hmm.
really don't want to go through all the arithmetic. It's just, here's the net, and make the arithmetic available, of course. But that's what you're trying to drive home is, here's the final, here's in the finality what happens. So,
Mm-hmm.
and just to kind of sum this up, if you're running into problems, one way to change the insurance frame, which is working against you, is to change the loss, the coffee a day, talk about COVID, or change the reward.
Mm-hmm. Yeah, as we've been
Those three
talking
things
about,
can
obviously that
make
second
your decision.
item I
Sorry.
think is top of mind, the perception of risk, mortality, morbidity. What about that LIMRIS survey?
Yeah, this is underwriting is a has to do with framing, and the problem we have with it is the typical response is it's not a hassle, and the answer is yeah, it is a hassle. A new insurance company was formed in Texas by some computer people that just found the underwriting process too much of a hassle, and they decided to offer now less invasive insurance underwriting for life companies. We'll see how that goes. But it is a real market. And there's ways to confront this. And the way to confront this is to admit that it is a hassle, but you're getting a benefit from it. And the benefit is you can offer them a non-underwritten guaranteed issue life. You can say, 800 bucks a year, you can get the policy, and you don't have to answer any health questions. Nobody's going to call you. We'll just issue it. However, if you'll agree to put up with some of the hassle, you can get a discount, 25% off that full price, maybe 50% off that full price. Essentially, the underwriting process is acting like a coupon. So will you use the coupon, like all smart shoppers, to get a discount from full price? So the reframing on underwriting is admitted. It's not something that's is enjoyable, but it comes as a coupon. And smart people use coupons. The bottom line on it all is the underwriting process pays off. And at worst, you can always go back to the guaranteed issue.
Yeah, I'm going to ask a polling question here. I would certainly, we have our own thoughts, but I'm going to ask the audience here about their life insurance underwriting experience. And uh, frankly, during this year of COVID, has it been faster? Maybe people moving to SPL or whatnot, auto-generated. Slower, I kind of frame that as a 1 to 20 days, and then much slower, maybe 21 plus days, or about the same. So I'm going to have that out there for a little bit, just kind of get your feedback, and I'd be happy to say, here at IAMS, I'd say generally it's been slower, probably in that 1 to 20 days. We do a lot of work here, obviously, to shepherd those cases along. Some cases have been much slower, but I'd say generally it's probably been in that 1 to 20 days, and a lot of that's getting labs, medicals from doctors' offices, frankly, has been the slowdown. Some of it, I think, the carriers also just being slow in responding. So I'm going to go ahead and close that and share those responses. So interesting, it's a little bit of a mixed bag. Some 24% saying faster. Yeah, I don't know if I have a great insight on that, other than maybe moving to automated underwriting products. Jack, any insights on that? It looks like generally more people, I guess, would say a little bit slower, but good chunk said faster too.
Yeah, it's just interesting results.
Let's move on to the next slide then, which is framing it in comparison to a couple other financial instruments. So we got investments. Yeah, investments, the bank, and then SPL, and kind of thinking about the framing on each of those.
Yeah, this is really more about when you're talking about this for an estate purposes. Somebody's talking about leaving money for their heirs, you can kind of compare where the money would grow to. So this is when somebody's talking about, I want to leave an estate, that's why I have money in the bank or I have money in investments. One way to frame this is to say, well, possibly the best estate creator or the best estate creator historically has been life insurance. And for $100,000 at your current age, the worst case is your heirs are going to get $193,000, and that's guaranteed regardless of what the market does and regardless of what interest rates do. So a different way to frame things based on what they're looking for. Taxes are becoming less of them, right?
Yeah, from a tax perspective here, it's dollars and cents. SPL would certainly be money ahead depending upon the tax bracket.
Yeah, it's not as big a point as it used to be, but it's still a point, is that you don't mess with the tax man when it comes to life or annuities. The money remaining in there does not generate a 1099. It's one less thing you have to worry about and one less hassle to put up with each year.
So let's take a look at that scenario. I kind of like the way this is framed.
Yeah, this goes back to a real world situation. I have a friend I walk with every week, and he's an insurance agent, and we talk and solve all the world's problems. And a while back we were talking, and he seemed concerned and upset about something, and I said, well, what's the deal? And the story was this: he got a referral to another prospect, a 39-year-old guy with 4 young kids. And he called up the person and said, would you like some life insurance? The guys, well, sure, but I had open heart surgery 2 years ago, and I've been told I can't get life insurance. And my friend said, well, let me see what I can do. So he made some calls. And the first couple carriers said no, and then somebody said maybe table 2, and then he finally found somebody that said we do the standard issue. So my friend's delighted. He calls back the gentleman and says, good news, I can get you life insurance. And he said there was like a 15-second pause of just dead air, and then the guy said, oh, that's great. I'll let you know if I decide to do something, click. Friends go, I don't understand, what went wrong? I said, well, here's the deal. First off, he never really accepted that he would buy insurance. Yes, he's got 4 young kids, but nobody's going to sell me insurance anyway, so I don't have to think about it. So he never decided really whether he's going to buy it or not. The other thing is a lot of people confuse easy and quick. And because the answer got back to him so fast, the guy probably assumed I can get life insurance from anybody, because look how quickly this agent got back to me with somebody who would sell me life insurance. So I must be in better health than I thought I was. And if I really need life insurance, I can buy it anytime. So what should have been done is like this one shows. When you get the story the first time, the agent should have said, I'm not very optimistic. I'll see what I can do. But if I can find a carrier that would actually underwrite you, and you're probably going to pay a lot more, would you buy the life insurance? And that'll give a chance for the client to really think about this. And he may say no, which means you've saved yourself some time. Or the prospect may say, yeah, I would buy life insurance. And essentially you've got a sale. And then even though, because of your expertise, you're able to find an answer in a few hours, you shouldn't call the client back the same day. You should wait a day, maybe wait 2 days, maybe 3, hope the client's still around, and then call back and say, I had to do a lot of calling, I had to do a lot of digging, but I finally found somebody that would underwrite you at standard underwriting. You'll pay no more than the average person. We better get an application in quickly before the insurance company wakes up. At this time, you've got a motivated buyer that's going to get insurance and is going to think their agent is the greatest person in the world. So that's reframing.
Yeah, I wonder if this person's just waiting for their second heart attack or something, Jack, or
It might
but
be, but that's how it could have gone down.
right. And in the reframing segment we have here, you make the point, it helps that there is a real urgency, but it's not essential. Review what's happened to the people that waited. So some of that go to, I know the other programs we've had, we talked about herd mentality. So is that some of that is just kind of, other people have benefited as you could?
You do want to talk about that millions of people have life insurance, millions and millions and millions of people have life insurance. So yes, be part of the group.
Let's move on to slide objection preemption. And I know your first point there about anticipating objections. That's a good one. I think we've covered that on some other programs too, is just kind of being ready for the likely objections you're going to get, questions you're going to get.
Right. This is not why they should buy. It's why they're not buying. And if you've been in the business a while, you know the questions people are asking and the excuses they're giving for why they're not buying life insurance. So what you need to do is address those and come up with real life answers, because sometimes they're not excuses, they're not objections, or excuse me, they're not excuses, they're true objections. The person does not need insurance. The person cannot afford insurance. But so often it's a bias, a screen, and you need to cut through the bias. And you can do that by preempting the objection. Too expensive? Okay, that could be an objection. Or they don't need it, they feel they don't need it. So you come up with answers to why would somebody need life insurance? And the answer is, well, nobody needs life insurance. The need what life insurance does. That's sometimes to create a lump sum of money, but it's more often to create a stream of income that can replace a pension or replace assets that go away with death. So, okay, we know what we're doing. Now we need to frame the objection. So we understand now that $10,000 is going to go away upon a death, maybe the pension dies. How can you replace the $10,000 worth of income? Well, there are a lot of choices, but one way is to do that with an income annuity, which when I did this slide would have taken about $120,000 at the person's age. How do you get the $120,000? Well, one way to do that is if you're spending $2,000 a year, you can buy $120,000 worth of life insurance. So that is one way to cover the need you'll have upon the death of the person.
Miracle in the briefcase, right?
Yep. Where do you find the 2,000? Because that's a lot of money. Well, if they got money sitting in CD, you can move it to a fixed annuity. That would free up the money. You might fund it with an immediate annuity. Again, if they got 200 grand sitting in the bank or whatever money, 32 grand moved into a life-only immediate annuity at this age, and I think the age is like 68 or something, generated a $2,000 income that could be used to pay the premium. And the interest only drops by a small percentage. Another way to find the money. So we've identified the problem, we found the solution, and we've paid for it. And then you kind of put it all together and you say, do you have any income that stops if your spouse dies? How are you going to take care of that? One way a lot of people use is life insurance. And again, you face reality. It's not free. Life insurance costs money, but it's preferable to many other alternatives. Why don't we see if you have any assets that are not pulling their financial weight, which is a really strong line, and see if any adjustments are needed, not selling and buying, because all you need to do is protect that income. Or maybe all you need to do to protect the income. And that's putting the whole thing together.
Yeah, great points there. I guess in the context of COVID, is fairness, I think, I don't know, personally, I feel like, there's a little bit of a bias against the life insurance carriers by clients generally, is somehow they're kind of, I don't know, a lot of this is behind the scenes. They don't really, maybe not as much transparency. Is fairness kind of more important? Like we kick things off here, we're wrapping things up. Is fairness even more important today, I guess, because of
Yes,
uncertainty in COVID?
it's COVID, but more than that, it's the low interest rates. The bank has not lived up to their end of the bargain. The deal when you went into retirement is the bank was supposed to give you enough interest that you could use that to spend in retirement. And the bank failed the bargain. So a lot of seniors especially are looking for places that'll be fairer with their money. And annuities and life insurance are one way to do that.
Great. I'm going to launch a poll question here. If folks would like the free copy of Dr. Marrion's white paper on today's topic about irrational biases with life insurance, we'd be happy to get that out. So go ahead, answer yes to that question if you're interested in getting that. Maybe you didn't get it when the invite came out, but be happy to get that white paper to you. Keep that open here for a second. Yeah, I think a great topic today, Jack. Just, obviously in the context of a financial product that so many people need. Seems like life sales, I think generally over the last 10 years, maybe even longer than that, have been flat. And unfortunately, we got to help our clients figure out why they need it and position it in the right light, and in light of the biases that they have are. So I'm going to wrap things up and just say, thank you, Dr. Marrion, for your look today into the irrational biases of life clients and have some strategies how they can overcome them. Thanks again to North American Company for their sponsorship, and certain all of our attendees picked up some nuggets that they will be able to take back implement into their business right away to help you grow your sales and reach your fullest potential. I'd encourage everyone to call your marketer here at IAMS today at 800-255-5055. Ask about a couple of these free items we have for you. One, the Dr. Marrion's white paper. Again, we happy to get that to you. Second, the consumer-facing Smart Wealth Accumulation IUL guide. And then third, we're happy to give you a customized free marketing analysis report to see if your advertising is aligned with your target demographic and to help ensure that the right marketing message is connecting with them. Something we could do for any of our customers. And a good time to be thinking about taking a look at your marketing as we're rolling into 2021. So as we wrap up the final webinar program in the Elevate Your Sales EQ series with Dr. Marrion, I want to thank Dr. Jack Marrion again, and also Tia Stanley with North American. We're happy to see record number of advisors register, over 1,000 for the series that we did, and pick up some great best practices. Call your marketer for access to any of the 4 other programs that you may have missed or you want to replay with Dr. Marrion in that Elevate Your Sales EQ series. And to all the advisors on today's program, thank you. Thank you for joining, and we appreciate the partnership. Please stay safe.